Okay, so
Damn,
you're
getting some
recording.
thunder over here.
Yeah, that's loud.
Oh,
Did you
jeez.
hear that?
Yeah. Some thunder for the podcast. Welcome back, everyone. We're back, episode 3 of the podcast that no one wanted.
I
I'm
wanted
Zach.
it. And
Oh,
we're here.
I wanted it too.
We're here.
We're here.
Zach, introduce yourself in case
Zach
the people
Robert.
don't know who you are.
Yeah, I'm Zach Robert, co-founder and CTO of Adesic.
And I'm Drew Gillen, co-founder and CEO. We have a very great episode we've been putting together for you guys here. Some exciting topics to talk about. We've got the crypto clarity bill in the news right now. This is a big one. Privacy coins as well. That's going to be an interesting topic. Privacy coins have been taking off recently. More stablecoin talk as always. What else do we have, Zach? Paying some vendors, I think.
Yep, we got paying people with stable coins. We got large buys, particularly and what that entails, spreads and slippage and the likes. And I think that's it. I think that's all we got. That we got a loaded program today.
And we got a few interesting topics to talk about. I'm excited to talk about the Clarity Act. I think this is going to be super interesting.
Oh yes.
But before we dive into that, we wanted to remind everybody about our special offer that we have going on right now. So we have a win your money back and referral program, you could describe it as. Right now, we're running this promotion where new users that sign up, activate their account, and move $10,000 within 30 days of activating their account, will pay you guys $50 in USDC. And if you refer any friends to this offer and they move the money, that $10,000, we'll pay both of you $50 in USDC. So we've got this going on at the moment. So anyone who needs to buy or sell stablecoins, check it out. Links in the description below. And don't forget to smash that like button as well, right, Zach? I think that's what they say.
Smash that like button, right?
Yeah.
You gotta ask the audience for some likes. That's how they say.
Yeah, smash that like button. Give us a thumbs up.
Yeah.
Right.
Yep. Especially
get some
if you found
W's
any
in the
value.
chat.
Yep.
Amen. All right. What else? Oh yes, we got an exciting announcement we need to make too. So we are launching our partner program. This is the best way to describe the partner program is it's basically like it's for other businesses that kind of are interested in moving money on behalf of their customers. So they would sign up with us, open up a master account. They could create sub accounts and then programmatically, onboard their customers and kind of orchestrate customer transaction flows. So this is kind of like a white label type of product. What do you think, Zach? Does that make sense about the partner program?
Yes, that makes sense. True.
Anything else to add to that, Zach?
Go check it out. We'd love your feedback.
Yeah. It's in beta right now, but the sub account feature's live. You can go and execute the transactions directly on our dashboard on the website if you're a business. And yeah, we'd love to get your feedback. It's been requested by a few of our customers, and we're excited to launch it here publicly.
There's also a kickback too. You get paid out based on the transaction volume that your customers do. You can set your own custom fee. That was highly requested too, and it's implemented. It works.
Yeah. So if you know someone, or if you're a business and you have customers that are looking to buy or sell stable coins or other cryptocurrencies, you can utilize this partner program, this feature, to generate revenue and allow those customers to buy or sell crypto directly through our application, both through our website as well as our APIs. So some exciting announcements for sure. That being said.
Oh, there it is. The clarity.
The big topic. Yes.
Yeah, jumping right in.
Let's jump right into this one. Zach, what do you think about this clarity bill? I'm curious to get your thoughts about this.
Yeah, this clarity bill was supposed to be the bill of all bills, provide the clarity needed in the cryptocurrency space for large investors and institutions to get in on the action and really start I don't want to say like making money, start transacting without any risk, provide all the guidelines, and it seemed like this was going to be the case. It still is going to be the case, but more people have entered the discussion on this, specifically the bank lobbyists.
Yeah.
And so the bank lobbyists got in and made some changes that a large stakeholder, Coinbase, uh, was not too happy with. And that's the latest news on that. Drew, do you have
Yeah,
any
yeah.
insights on this? I
I
mean,
mean, I
yeah.
think it's super interesting. I mean, there's two big bills that the Trump administration was really championing behind for the crypto industry. One of them was the Genius Act that passed recently this year for stablecoins, which is amazing. And then the other big one too that they were behind is the Clarity Act, which we're talking about now. It was a bipartisan bill, um, and I don't know. There's a few big issues. Like you said, Zach, Coinbase was they were pushing this bill hard. Really, I think too what the goal of this bill is to like provide clarity for the crypto asset classes, right? In a sense, from a regulatory perspective, there's kind of like a gray area. Like the SEC in the United States a few years ago was classifying all of these cryptocurrency tokens as securities. That was causing a lot of issues. And so the goal of this bill was to provide clarity of like who is like regulating the industry kind of in the United States and how these different cryptocurrency tokens from like meme coins to like Bitcoin, utility coins are being like legally or classified, I guess. Is that kind of like a fair description of kind of what the initial aim was?
Yes, that is very fair.
Yeah, and I guess what's happened recently is, like you said, like the bank lobbyists got involved and they started murking the terms of the bill. And now Coinbase, who was originally like the one really pushing for this to happen, is kind of has taken a step back and saying like, "Hey, what's going on here? You know, there's a number of issues." Um, Lauren, could you actually pull up kind of the tweet from Brian Armstrong? I think this would be a good time to show that.
All right, so I'll read this. Okay, so a tweet from Brian Armstrong says after when was this? This was January 14th, 2026. So this was 5 days ago as of recording this. After reviewing the Senate banking draft text over the last 48 hours, Coinbase unfortunately can't support the bill as written. There are too many issues, including one, a de facto ban on tokenized equities, two, DeFi prohibitions, giving the government unlimited access to your financial records and removing your right to privacy, three, erosion of the CFTC's authority, stifling innovation and making it subservient to the SEC, and four, draft amendments that would kill rewards on stablecoins, allowing banks to ban their competition. We
Yeah,
appreciate, yeah, and
that
he goes on to say, we appreciate what everyone's been doing here, but changes need to be made. We're confident we can find a happy medium.
yeah, and I believe like Coinbase pulling out of this caused a little bit of I don't know a disturbance in the White House or something like this. It was reported on the news or whatever that this caused some disturbance in the White House. But they're still working on the bill,
Mhm.
I think at a high level, what's happening here is like the banks are getting involved, and like you said, Zach, they're trying to crush out kind of their competition. And really, the big thing is like this stablecoin reward system, where the stablecoin issuers like Circle or Tether or Paxos are like they're not being allowed to pay interest off of the treasury bills to the end customer, and that's a big issue there. Um, the
So
other, yeah,
Can we linger on this too? The interest entails, right now, Coinbase is one of the biggest ones paying interest or paying out interest on behalf of Circle. Uh, Coinbase offers 3.5% APY on USDC, which is a lot better than the average APY, savings account APY at banks, which is, I think the national average is like 0.62%, so it blows it out of the water. And then the banks are worried that people will stop depositing money into their savings accounts and then in turn go to Coinbase and get 3.5% APY.
yeah,
That's
and
the
that's a
big
big
concern.
thing. Yeah, that's on the stablecoin piece, and I think too, like even just some of like the classification of the cryptocurrency tokens. Like I was reading about this where I don't know. They're like muddying the water of the way these tokens are being classified. I'm not super sure on like the specifics of the details, but I believe they were going as far to say as like some like meme coins are being categorized as like securities or something like this. I don't know if that's 100% accurate, so don't quote me on that. But that is kind of like a problem the way these tokenized equities and kind of real world assets are kind of being banned or being classified as securities, it makes it very difficult. And
Hmm.
because of this, like the second order consequences of implementing these regulations is we're gonna see kind of innovation move off of shores of the United States. Like people are not
Hmm.
going to be issuing these tokens, working on these innovative projects in the United States if they know they're going to get arrested or if they know they now have to classify it as a security. It just creates a massive amount of friction to go to market in the U.S. So I really do hope that Coinbase and everyone involved in putting this bill together are able to kind of work through these issues.
Yeah, token listing should. They're obviously going to happen, right? That we would probably want them to happen in the United States, right? I don't think we wouldn't want them. They should also happen. They should be regulated for the sake of investors and everyone at play for so every there's no scams essentially, right?
Yeah.
Um, and I think that that's very important.
Yeah, it's got to be a happy medium.
Hmm.
And we'll see how it plays out. I don't know. Either way, though, this is kind of it's big news in the crypto space for sure.
We can linger a little bit on the yield for stablecoins too. Previously, the Genius Act also did ban yield on stablecoins. That was passed. The Genius Act was passed in June. But there was a loophole that was found where third parties are able to offer yields on stablecoins, and so that's why Coinbase was a third party on behalf of Circle. That's why they're issuing the yield on those stablecoins, that 3.5%. Um, but they want to ban that outright completely, and
The
so
banks
we.
do. The bank
Yep,
lobbyists.
the banks do, yes, because they're worried about deposits being moved onto Coinbase or those entities that are offering the higher yield. And when deposits slow in banks, then lending is also
Impacted. Yeah.
yeah, lending's impacted on banks. And I think this was very interesting because Coinbase is they file for a banking charter. Is that true, Drew? Did you hear?
Yeah, I believe, and Circle too. I believe Circle recently got
Yes.
approved for their OCC Bank Charter Trust or something like this. I'm not entirely sure the exact term, but yeah, there's even Bridge that was bought by
Yes.
Stripe also applied, I believe, to be a bank charter. So
I
um,
think. Do you think this is like a call for banks to innovate? Like
oh
they
yeah,
haven't
yeah,
done any, they haven't changed for so long, and now they finally have competition, and they're going to the government and they're saying, "Hey, we don't want competition, right? Like stop this."
yeah. What is it saying, right? If you can't compete, then like you got to regulate it out of existence, and it seems
Yes.
like that's what's going on. These big banks they're scared, and
Mm-hmm.
I mean, I was just talking to a customer the other day, and he was saying that he was trying to send a large wire to Coinbase, and his bank was asking him, what is this? What are you doing here? And ultimately, they were asking for like a bunch of documents on the wire, the use case, and they blocked it. They said like, look, you can't wire money to Coinbase, whatever. We don't support crypto here, and they return the wire back to the originating recipient. So, I mean, I don't know. These banks, I don't
They're
understand.
scared.
I
They
don't
got
understand.
the whole banking industry as a whole. We're seeing some type of change, whether it be the rails or how they're regulated or who's involved. What is a bank? What is a bank? Maybe the whole question is what will change in the next couple of years here. But we're finally seeing some change to an industry that has long been the same,
Money,
boring,
yeah.
more money, and
Money
yeah.
is one of the most regulated industries in the world. I would say top three for sure, right next to like war. Right, war is a pretty regulated industry. But so I don't know. It's money is up there, and probably next to speech as well. I don't know. It's
Speech.
it's
Oh,
super
that's a
interesting.
very interesting take.
Yeah, and what's even interesting to dive a little bit deeper into what you're saying, Zach, like about the banks. What I've learned from my experience over the last few years is that at the highest level, like money, specifically the dollar, is controlled by the government, the Federal Reserve. There's like trillions of dollars flowing through the Federal Reserve every year. So like you have the master bank at the top, and then you have the next line of defense underneath the Federal Reserve, which is like these larger banks like J.P.
The
Morgan Chase,
institutions.
Bank of America, etc. And I don't know, but that's the way it's structured. And then underneath them is the fintechs, and that's where like we come into play here. And banks are scared of the fintechs. I don't know, they're the thing, and I'm just wondering how to play out.
It's already being eaten.
Yeah.
We have the rise of the neobank too. Do you even need a bank with USD? Can we do banks with USDC only? Or there's got to be some fiat flows now, but
What
the
do you think,
neobank, the
Lauren?
concept of the neobank is very interesting. Well, yeah, what do you think, Lauren?
I think we've talked about Adesic reminders. We've talked about the US Crypto Clarity Bill. And we've talked about banks. And I think it's time to move on to some questions that people in our crypto community have been asking us. I think we should move on to the first question, which is, how do you pay a vendor using crypto?
It's a good question.
Well, that depends. That depends here. We have this concept of the neobank. Does the vendor is the payment starting out in a fiat currency? It is could be very interesting. Without payments in a fiat currency, crypto is by far the fastest, easiest, cost-effective way to do this.
Yeah, I mean, to take a step back here, right? We're assuming that the vendor wants to be paid in crypto. Like that's kind
Yeah,
of the
correct.
the assumption of the question. Um, and there's various reasons why a vendor would want to accept payments in crypto as well, faster, cheaper, etc. Right? So like then the question becomes, well, do you already have crypto to pay that vendor in, or do you not? Right? If you don't have the crypto, you need a way to acquire it. That's where a platform like ours could come into play, or you could use like a Coinbase type of company. But if you were to use us, the easiest way to acquire crypto would be like if you need USDC, USDT, you send a wire to us, we'll send the crypto right to your wallet. Once the crypto is in your wallet, you can send it directly to the vendor.
Yeah, that makes sense. I think it depends how the vendor wants to be paid. Usually, yeah, I mean,
Yeah.
we're seeing more and more crypto, and then it's about acquiring the crypto, and we have a very nice way of acquiring the crypto uh, for various reasons, and this is a top use case.
Yeah, a big use case. Oh, I guess one thing or one big difference between us and a platform like Coinbase or Kraken or any of these larger exchanges is we send the crypto right into your wallet. So this is like your self custodial wallet, your Ledger, your MetaMask, your Phantom wallet, right? It goes right in there, and then you have full control over your money. Versus if you were to do this on Coinbase, you send the wire to Coinbase. Coinbase still has control and custody of those tokens and of those coins. You still got to go through the dashboard as well on Coinbase and configure the buy order and everything. And then if you want to extract it to your wallet, it's just extra steps, right? And of
Hmm.
course, we simplify everything to make it really easy.
Not your keys, not your crypto. And then have we heard about platforms like Coinbase capping with crypto withdrawals? Is that a thing?
Yes, yeah. I mean, there are limits, transaction limits for large transactions on platforms on these exchanges as well. So that is definitely a thing. The amount of money you could push into as well, like if you're doing an ACH transaction, you can only buy so many tokens within a day.
Should we talk about why that is the case with ACH transactions?
The ACH rail in particular,
Yeah.
yeah, it's a good question. Go ahead, folks.
Yeah, so ACH in particular is reversible by nature, where crypto is not. So what we see for like a scam or like a fraud capability, as a fraudster, ACH in particular is attractive for buying crypto because you can send an ACH payment to a crypto company, acquire the crypto, and then initiate a chargeback. So you've essentially got that crypto for free, and so that's why we see large withdrawal. We don't see we see withdrawal limits. Sorry, deposit limits with ACH.
Yeah. The true is for the credit card networks as well.
Hmm.
Credit card networks also come with additional markup fees too. Sometimes
High
an
fees, yeah.
extra 2 to 3% on transactions versus like an ACH or a wire.
Yeah, ACH is either free or like very cheap, like 35 cents per transaction or something like that.
Yeah.
That's on the expensive side.
RPT too, which is another payment network in the United States. It stands
Real
for real
time payment.
time payments.
Yeah.
I believe so. The Federal Reserve, the bank runs that payment rail as well. Also, all of the wires in the United States go through the Federal Reserve, which I think most people don't know. So there's this thing called FedWire, and there's also this other thing called Fed ACH. And so all the ACH payments go through the Federal. Most, I'm not saying all, most of the payments, ACH and wire payments, go through the Federal Reserve, and then the RPT goes to the Federal Reserve too. And I believe there's like a transaction maximum for RPT2. I want to say it's like
RTP.
RTP, correct. I think the maximum there is like 1 million or 10 million, maybe. I'm off by a zero, maybe, but it's one of those.
So why do all the wires why do wires go through a central governing entity like the Federal Reserve?
I
Why?
think it's trust, right? I mean, people
Yeah,
trust the government, right?
you trust a third party. The government is a very trustable third party for most people,
Yeah,
like institutions. These large banks, they yeah.
and it makes sense too. Like, who's going to bail you out if the dollar doesn't arrive via the wire, right? The Fed is. So
Uncle
that's why
Sam.
all the money flows through there. Most people don't even think about this, but
This comes with surveillance too, and a lot of other things as well. But
let's kind of shift over to the next question. Not so much a question, but just more so a topic. I know privacy coins have been trending lately, and I know Drew really wanted to talk about this topic. So, Drew, do you want to start us off with like what is a privacy coin for those who don't know, the use cases, etc.?
yeah, I mean, privacy coins are super interesting. They've really taken off too. It seems to be one of those like major trends. There's a few tokens, Monero and Zcash recently in the last few months. I don't fully understand the technical limitations of what they can and cannot do, but we're seeing like a massive trend taking hold here, where not only is these privacy coins like Monero and Zcash are shooting up in price, but we're also seeing a bunch of investments from large venture capitalists coming into play, trying to make stablecoin payments private. And I guess the reason for this happening is because everything is kind of like open source. It's all on the blockchain. Anytime you make or initiate a transaction on any of the major blockchains, the EVM, the Ethereum ecosystem, Bitcoin, Tron, right? All of these transactions are public. So we're seeing, I don't know, we're seeing a big rise here. What's your take on the situation, Zach,
yeah, we
or
were
the
just
trend?
talking about the trusted third party, right? The government was a trusted third party. Everyone trusts the government. They bail you out. These privacy coins shake things up. They say there is no trusted third party. The trusted third party is the code. It is the algorithm. The verification. It's not even the verification. It's just an algorithm that cryptographically signs these transactions, and without a trusted third party is what it boils down to. And this is very powerful because, um, well, for the first time ever in payments, there's no centralized entity that says yes or no to a transaction.
Yeah, and it's kind of like visibility too. So you can't actually see, your wallet balance on these tokens either. I might be mistaken, but I believe that that's how it works. So you can't actually see, review the wallet balance and how much tokens they have, how much money they have in there. So it's really private. And this kind of circles back to the previous topic we were talking about too, with the Clarity Act. I believe like one of the issues with the current draft of the Clarity Act is like this privacy erosion issue, where these regulators, with the current drafted bill of the Clarity Act, it's like, I don't know, the regulators will get broader access to the user data. So it kind of removes the current draft of the Clarity Act removes this financial privacy rights. So like privacy is like super important. You obviously don't want people seeing everything that you can do. That's why like cash is like a super popular transaction method in the United States, because it's private, it's peer to peer. There's no intermediary. And I guess that is kind of the attraction that these tokens offer.
As crypto becomes more regulated too, we're seeing the IRS step in and say, hey, we want to know your crypto transaction history. And by the way, we have this ledger that we can go back and see everything, all the transactions that happened anyways, but we want you to report your transaction so we don't have to do that. So it's kind of just like haha, gotcha. We have visibility, but we don't want to do it because it's a big and complex, but it's there. So now we're seeing this form called the 1099-DA, the digital asset form, where people have to go and report their crypto to cash transactions. I think it's specifically just selling crypto for cash, the off ramp, if you would, and this ZK zero knowledge privacy coin kind of flies in the face of that and says, well, It's like cash, um,
Yeah, and it's a broader trend too. There's large investors like A16Z who's really pushing this as well, with their latest investments into the crypto space, promoting privacy. So I don't know. I think it's a really interesting topic. I'm curious what will come out of that. One exciting idea is like private stablecoin transactions. I'm curious what that could potentially look like. Like all of the public stablecoins, like USDC, USDT, they're public. What would a private version of that look like? I don't know. But I think it's a very interesting topic to keep an eye out for, and the market is clearly interested in it as well, considering these major price gains in the last few months.
on the topic of ZK, it looks like this is headed towards the stablecoin market, particularly with USDC. It looks like they're doing some experiments with the ZK Sync Era platform. Again, this is just ChatGPT. I haven't delved too deep into this, but it looks like that's where this is heading, and we're definitely towards the end of the year. We're going to start seeing platforms like Circle, USDC, integrate in with ZK, and I think that's going to be very powerful.
What else do we have? What other topics, Lauren?
All right, so let's move on to another question we're getting is why stablecoin execution matters more than the token itself. When two people buy USDC, why do they get wildly different outcomes? Well, how should businesses think about stablecoins as infrastructure instead of assets?
Yeah, that's a good question. This actually came up in a conversation I was having the other day with a customer. I guess we'll talk about the two biggest stablecoins, which is USDT, Tether, and USDC, Circle. Um, for companies in the United States, I guess the biggest difference between them is kind of like access to the infrastructure, to the rails. USDT is closed off to United States companies. To work directly with Tether, is basic. You can't do it with a U.S. company. You have to be an international entity. So as a result of this, it makes it more expensive to access these USDT networks. So like that's why there is like a spread, right? The one USDT is not always quoted for $1 on large exchanges like Kraken or Gemini or Coinbase, versus with Circle, for example, USDC. USDC is fully compliant via the Genesis Act, and so you can easily acquire one USDC for $1, especially on platforms like us, as well as Coinbase and these different entities, because Circle is able to directly service the United States markets.
You meant Genius Act, right? Over the
Yeah,
Genesis Act.
Genius Act. Genius Act. Sorry. Yes.
No, that is very powerful, and there is arbitrage opportunities, is what my brain immediately goes to. You have an entity that's set up in not in the United States, and you have one that is set up in the United States. One has a Circle account, the other one has a USDT account. Arbitrage on the open markets and the exchanges. Granted, there's already a lot of people doing this, and so the spreads are rather thin, but the opportunities there.
It's the access piece, I guess, is kind of why it matters. So like it's easier to access USDC for US company versus USDT. And when I say that, I mean like one to one.
We did hear there was news a little while ago about Tether opening up a US entity. I'm not sure if that went anywhere, if that's still in limbo, what the status of that is.
Yeah, I believe they're planning to actually launch a compliant US stablecoin under the Genius Act. I'm not too sure how far along they are in that process, but they have announced it. And yeah, so that's something to keep an eye out for too. But yeah.
Now, what would this look like? Would this look like a similar structure to Circle's USDC, where the Tether entity buys government debt, US government debt, and then in turn issues that stablecoin and then gives yield on that, or can give yield on that?
Yeah, you're probably spot on there. I believe that's exactly what it would
Yeah,
look
why
like.
reinvent the wheel, right?
And one of the reasons why USDT is not fully compliant under the Genius Act is because USDT is not fully backed by US Treasuries. So I believe Tether holds in their reserves like gold and Bitcoin, as well as US Treasuries. Granted, they're over collateralized, right? So like it's more than 100% collateral for the issued USDT, but because it's not 100% collateralized by Treasury bills. it causes these issues where they're not fully compliant under the Genius Act. And it seems to be working for them too. I mean, they have gold, Bitcoin, treasury bills, but I don't know.
What are the odds of like a bank run, or if a bank run were to happen with USDT? Would what would happen? Would there
It's
be
a
a
good
US?
question.
No one ever thinks there's going to be a bank run. What I wonder, like, what would be a cause for a bank run with USDC? We had Terra Luna, which everyone said, oh, that one's going to the moon, went to zero, but everyone thought that one wasn't going anywhere, but overnight disappeared pretty
Yeah,
much.
there was when that happened too, USDC depegged from the dollar
It did.
uh,
Everyone
for
got scared.
for a
Was
few
that
days.
with the when the banks collapsed?
Yeah, Silicon Valley Bank, and there's like
Mm,
another bank, I think.
So, what actually breaks when you move $10K to $10 million in crypto? And I know Drew, he gets to talk about his favorite topic, which is the OTC desk here.
Yeah, no, that's a good setup there. Yeah, so if you need to move like large amounts of money, what happens is like the rate that you're converting the transaction at. There's like slippage, basically, is what happens. The market moves, no matter if you're buying like I mean, especially if you're buying an asset like Bitcoin, where the price is very volatile. Even with a stable coin too, like USDT, like we've been talking about, the market is going to move, and if you want privacy, this is when like you would come in and use an OTC desk like us to execute the transaction, where we can do it privately behind the scenes. We can break the transaction down into smaller sizes and process it at like a guaranteed rate, essentially. So for OTC desks like ours, the way the kind of process works is you would request a quote, and we would provide you with an exact amount of that token that you would receive. So if you wanted to buy, I don't know, like $100,000 of Bitcoin, you specify that, and we will return back to you exactly how much Bitcoin we could send you for that amount. There would be no fees involved there, right? The way we would make the way the OTC desk makes money is off of the spread, right? So I don't know. To reiterate, when you're moving massive amounts of money, the spread can add up, right? And the execution quality can go down if you kind of don't know what you're doing.
Okay, short and sweet. Love it. Simple. Okay, so we are on to our last two topics here. So we have a blog on the quiet buyers. So how trusts, funds, and family offices accumulate crypto. Drew or Zach, whoever wants to take over this, have at it.
What do you got, Zach?
I think what we're seeing here is on-ramping transactions. So you take these entities fiat currencies, you convert them into crypto. This is called we see these types of transactions called treasury management. And so what we usually see is treasury management happening on some sort of regular interval. Maybe it's quarterly, maybe it's once a year at the end of the year. You have some extra money in your balance sheet. Move it off the books, and how they do this we will circle back to last question, which we see large transfers happening via OTC style. I think that's my short and sweet answer for this. What do you think about this, Drew?
Yeah, no, I think that like the larger reason why we're seeing trusts acquire, Bitcoin, acquire these stable coins, these family offices, is to kind of like help build generational wealth for their family, right? These people, whether they're individuals or these funds, right? These offices, they see the value in having a diversified portfolio with exposure to Bitcoin or to stable coins, and they see the opportunities here. And so I think we're seeing more and more of this, where these family offices, high net worth individuals, funds, trusts are trying to acquire more Bitcoin, because there's a lot of upside here, as well as stable coins too. So I think it's interesting.
I think we see a lot of Bitcoin in particular because Bitcoin is so they say it's a long-term store of wealth. What do I mean by this? Well, Bitcoin is it isn't exactly inflationary. There's a finite supply of Bitcoin, and people keep buying it up, so that drives the price up. And also, it's compared against the U.S. dollar, which is inflationary. So the price of one Bitcoin it's compared to Bitcoin, it's always going to stay the same. But compared to the US dollar, since there's more of those in circulation, the price is going to go up. You can think of this as like $100 in the year 1900 is not the same as $100 now in 2026. If you were to buy $100 in Bitcoin in 1900, you'd probably be a millionaire just with that $100. And so that's why we see these trusts and these funds moving money into Bitcoin, preparing for the long term.
Yeah, well, a lot of upside there.
Mhm.
What's interesting too is like Benjamin Franklin did that, Zach, where he like put a bunch of money into a trust or whatever for, I think it was maybe the city of Boston or Philadelphia. I'm not exactly sure. And like that money grew significantly over time off that interest from like 300 years ago, 200 years ago, whatever it
And
was.
that was only like basic interest too. What like 3% per year, whatever. But that's probably
Yeah.
high. The Bitcoin has in the short term, but in the last 15 years, it's the value is just exploded, and so that's why they're trying to allocate a little bit of their portfolio. I mean, they, as in these trusts, these funds, these family offices, trying to allocate a little bit of that portfolio to get a little bit of exposure to then reap the rewards in the long
Yeah.
term.
Very similar to gold. Like these people probably have a little bit of exposure to gold in their portfolios, and now they're seeing the value in Bitcoin, maybe buying stable coins too, whatever it may be. So yeah, we help these types of people in these companies and these funds as well. So sounds like something you would need. We would love to help you with this.
Mm-hmm.
So we're on to our very last topic for today. So what have you guys learned from watching hundreds of real crypto transactions? I know you guys do this on the daily. I'm sure you're living it, you've learned, and you're still learning. So what have you learned?
It's a good question. What do you
Yeah,
at,
what a
Zach?
great question. I was gonna ask you what you got.
Man, I can talk about some mistakes, right? Common mistakes that I've seen people make. I mean, the biggest one is like not understanding that crypto transactions are non-reversible. So like I've seen and I've done this myself where like I've sent crypto to the wrong address and it's gone, right? So that is like by far the biggest mistake. You need to be 100% sure that when you're sending crypto to another wallet, that address is correct and the blockchain that you're sending it on is the correct blockchain. If you don't, your funds are no more, right? That is definitely the biggest mistake and the most costly mistake I've seen.
I think piggybacking off what Drew said, to sum it up, put a bow on it, execution really matters. And so what happens is, it's a lot of these crypto transactions, they have a human in the loop, and they're not foolproof. But what humans can do is write nice code to automate some of these, well-tested code that always does the same thing. And I think that is where execution can really shine, because not only is it the same thing every time, it is also fast, right? It happens instantaneously. It's event driven, and I think that is really powerful for crypto transactions.
Yeah, I mean, there's I don't know the sophisticated users. They build these automatic trading bots to do all of this crazy stuff. I mean, you have to be really careful when doing crypto transactions. Even us, right? Like for example, on the Tron blockchain, when sending a transaction of USDT on Tron, for example, to another wallet address, these bots will pick up that we just sent some crypto to this address because, again, it's all public information, and they'll send a little bit of dust to our wallet. And by dust, it's like a very small amount of the Tron blockchain. And what they're trying to do, this is like a type of scam. Back to like Zach's point, execution matters. This is like a scam that where they send this to try to mimic the address to try to trick us into sending crypto to their wallet. So it's like you got to be very careful to kind of understand the landscape. If you're doing all of this yourself through like a self custodial wallet, you'll get dust into the wallet, which is like again small amounts of crypto. They'll send you like fake NFTs, trying to trick you into sending your money. So you got to be super careful. You got to be diligent. Another common mistake that I've seen is like people will connect their wallet to these really sketchy applications. And once you do that, like what you're actually like signing off it on is that this application can take funds out of your wallet. So I've seen some mistakes where like their wallets get drained because they accidentally connect their application to like a I don't know like a scam or like a dirty app. So you got to be careful for that too.
Another thing is to be careful of is what wallet you use and where you use it. And this, I'm also piggybacking off of Drew here. We've screened thousands of wallets, and a lot of wallets come back as risky from the screening, just by what apps they've connected to. That it sets off a flag. Different P2P exchanges or gambling, or these are just the tip of the iceberg. But if you're going to use these things or different apps, these lesser well-known apps, it is worthwhile to spin off another crypto wallet and go and expose that wallet to those apps, and rather not your daily driver, because your daily driver will get flagged, and so will all of your funds.
So you got to stay diligent for sure. You got to be careful. There's a lot of mistakes that I've seen people make. At a high level, the most sophisticated users, like Zach said, it all boils down to execution. They kind of know what they're doing, and they're careful about it. That being said, podcast episode number 3. Ooh, right, there we go, Zach. Ready? There we go, dude. Signing off. Big episode.
Go make your first
Final
transaction
words.
today at adesic.com. Final words.
Yeah.
We got a referral program. Sign up, move 10K, get $50.
Get paid to move your money, baby.
Yeah.